Hi everyone, this is Mehul Mehta and welcome back to the session. In this YouTube series, we'll understand what is credit risk modeling. So there are a lot of job opportunities in the credit risk modeling space, and you see a lot of engineers being hired specifically for credit risk modeling. The one of the main reason is because the credit risk modeling, we do use a lot of Python, and it's been heavily utilized for the credit risk modeling. Now the question is, what will we cover in this whole video series? So let me brief you what are the objective of this whole video series. Okay, so we'll understand what is credit risk. Okay, then we'll look at what are the components of credit risk modeling. So what are the components of credit risk modeling? Then we'll look into what do you mean by 1 year probability of default versus lifetime probability of default. Then we'll look into the data set. How does the data set of a credit risk modeling looks like? And this is one of the most important interview question also, that what were the variables in your data set. A lot of times the interviewer will ask you, oh, what were the loan characteristics variable, what were the macroeconomic variable, what were the borrower attributes. So such questions are asked a lot of times in the interview. Then we'll look into the process of building a credit risk model. Okay. So this is on a surface level what will you see in the coming videos. So let's start. So the first thing is, what is credit risk? See, what happens is, let's say you go to a bank. Okay. Let's say you go to a bank and you say, hey, can you give me some money on loan? Why? Because let's say I want to pursue my education, or I want to buy a home. So to buy a home, it's called a mortgage loan. To pursue an education, it's called an education loan. To or let's say uh, if you want a loan for your car, it is called auto loan. Or let's say other loans can be personal loan. Okay. So let's say you go to the bank and say, hey, I want a loan of any of these. Let's say I want an education loan, right? So what the bank does in the back end is, it will basically take all your information. Okay. So what will bank do? Bank will take all your information. Okay. And run some quantitative models in the back end. Okay. And run some quantitative models in the back end. And then it will say whether I can give a loan or not. It can say whether it can give a loan or not. So let's say loan is not approved. What happens in the back end is, so what will bank do? It will take all your information and will run some quantitative models. Okay. And it will say whether the loan is approved or the loan is denied. I mean, just imagine, why will bank deny the loan? Why will bank deny the loan? The answer is, The answer for this is bank feels that banks feels that you might not be able to repay the loan. Okay, you might not be able to repay the loan. So bank has, so this kind of risk is called credit risk. Okay, this kind of risk is what we say as credit risk. So let me write a formal definition for credit risk. So the formal definition for credit risk is, it is the risk that borrower will fail to repay a loan. Okay, so credit risk is is the risk that borrower will fail to repay the loan or meet contractual obligations. Okay, so this is what we say as credit risk. Okay, this is what we say as credit risk. So it simply means that it is the risk that borrower will fail to repay the loan. See, but the question is, let's say bank knows if the borrower will fail, or let's say bank knows that the borrower, let's say if bank knows, let's say if bank knows that you might fail to repay the loan. Let's say the bank knows that you might fail to repay the loan. Then what will bank do? What will bank do? The bank basically charges higher interest rates to such borrowers. Okay. Bank basically charges higher interest rate to such borrowers. All right. And this is where, so if you see, so this is what it means by credit risk. Now, if you see, I said bank in the backend runs certain quantitative models. What are these models? This is where the concept of credit risk modeling comes into picture. Okay, this is where the concept of credit risk modeling comes into the picture. So, what is credit risk modeling? See, it is the process of using statistical, mathematical, or machine learning based models to quantify the credit risk. Okay, to quantify the credit risk. Now, so when we say credit risk modeling, what we actually means is three things: PD, LGD, EAD. Okay. And that's where, if you look at any job description for that matter, if you look at any credit risk job description, it will use this term PD, LGD, EAD. Okay. So what is PD, LGD, and EAD? What are these terms called? Let me explain you bit by bit. PD. PD is nothing but probability of default. If in case you have any doubts, please feel free to ask. Okay, please feel free to ask. So as I said, in the backend, the bank runs quantitative models, and all these quantitative models are based out of either statistics or math, or these can be mathematical models or machine learning based models. And eventually this credit risk modeling is divided into these three components. Okay, the credit risk modeling is divided into these three components: PD, LGD, EAD. So these are the components of credit risk modeling. Okay, so let's understand what is PD. PD is nothing but what is the it basically tells you what is the probability that the borrower will default. What is PD? So PD tells what is the probability that the borrower will default. What it means is, let's say if I say that PD is 10% and let's say PD of borrower 1 is 10% and PD of borrower 2 is 50%. What it basically means is the borrower 1 has 10% chance or has 10% probability of getting defaulted. Okay. Whereas PD of 50% means that borrower 2 has 50% chance of getting defaulted. So tell me one thing. If the probability of default is higher, does that signify higher credit risk? The answer is yes. So if the probability of default is higher, it signifies higher credit risk. And this makes sense also, right? See, if I know that, let's say, you come to me, I'm a bank, you come to me and you say that, and I run a quantitative model in the back end, and I got to know that your probability of getting defaulted on this loan is 50%. Then I might have to think whether to give you loan or not, right? Because you have a very high chance of getting defaulted. And if in case you get defaulted, it's a loss for me. So that's where this is the first component of credit risk, which is the probability of default, whether will you default or not. So this was the first component. Okay. Now let's look at LGD. Let's look at LGD, the second component of credit risk. So what is LGD? LGD means loss given default. So let me write the definition so that it's easy for all of you to understand. The percentage of the exposure. The percentage of the exposure that is lost if the borrower defaults is called LGD. Okay. Okay. And one more. Okay. After, yeah, this one is important. After accounting for recoveries. Okay. And let me give you an example to make this understand. Let's say if a bank, let's say if a bank lends $100. Okay. If a bank lends $100 and only recovers $30, then LGD is what? 70%. LGD is what? 70%. Now the question is, if you just look at the term loss given default, it is basically saying what is the loss given the default. We know that default has now happened. Let's say, in the first stage, which is the PD, we were checking whether the borrower will default or not. Okay, so this is probability of default. Now we know that the borrower has defaulted. So if you see the term given default, we know that the borrower has defaulted. now what we are trying to understand is what is the loss that my bank has to face. So if you see what the definition says is the percentage of exposure that is lost if the borrower defaults. If the borrower defaults after accounting for recoveries. What does this line means? See, let's think. Let's think. You have a home, okay? Let's say you took a loan. You took a loan, let's say $100,000 of loan you took, okay, for a mortgage for a home. Let's say you bought a home, okay? Let's say you bought a home for how much? $100,000, okay? And you took a loan from the bank, okay? Now what happened is, you know, suddenly you lost your job. Suddenly you lost your job, and so let's say year zero. Let's say this is a 15-year term, okay? Generally, if you see any home loans, those are 15 years, right? Or you can say mortgage loans, right? So let's say here you went to the bank and asked for $100,000 loan, okay? And let's say till up till this point, let's say you paid $10,000, okay? Up till this point, you paid $10,000 and you defaulted. Now, what will happen is if you see at this point, specific point, the bank will come in and will sell your property and it will sell your home. But let's say it now, at this point in time, at this point you have recession coming, it's a recession, and the bank, let's say, could only sell your property. Let's say the bank could only sell your property for $20,000. I know it's not realistic, but let's say, so how much the bank recovered? $30,000. And what was the loan amount? $100,000. So how much did bank lost? So if you see how much did bank lost, so $100,000 was the loan amount, $30,000 is what they recovered, and again total is $100,000. So if you see $70,000 divided by $100,000 is just 70%, is 70%, right? So this is the loss that bank faced. Okay. So this is what we say as LGD, which is loss given default. Okay. That how much loss the bank has to face given that the borrower has defaulted. Okay. Is this clear? Please let me know in the chat if it's clear. Okay. Perfect. Now the next term is exposure at default. Now the third component. Okay. The third component of credit risk modeling, which is exposure at default. This is what we say as EAD. This is what we say as EAD. So if you see the term exposure at default, let's say, okay, let me write the definition first so that it's easy to understand. So the total value the lender is exposed, the total value the lender is exposed to at the time of default. Okay. So let's say, so this is, it's, very, it's simple forward. I mean, if what it says is how much is the total value of the total value the lender is exposed to at the time of default, which means, let's say if a borrower has drawn, let's say if a borrower has drawn $80 of $100 loan, okay, and is expected to draw another $10. So how much did he draw? He draw $90, right? Out of the $100 loan, how much he has taken? He has taken $90. So therefore, exposure at default is how much? $90. Okay, exposure at default is what? $90. It basically means that at the point of default, let's say at this point of default, how much money how much money does the borrower owe to the bank? Okay, how much money does the borrower owe to the bank? This is what it means by EAD. That what is the exposure at default? See, at this moment, you know, the borrower has taken $90, okay, out of the $100 loan. He has taken how much? $100 loan. So this is what the exposure the bank has. That if he has defaulted, this is what is the exposure at default. Is this clear? Is this clear? Okay. So now let's let's combine all the three component. So what are the components? Three components of credit risk. It is PD, LGD, third is EAD. This tells you just the probability of whether the borrower will default or not. This gives you how much loss will the bank face. How much loss the bank will face if we know that the borrower has defaulted. If we know that the borrower has defaulted. Now, what is exposure at default? This is just the exposure the bank has at the point of default. Okay. Now, what will happen is we'll multiply all the three components, which is PD times LGD times EAD to arrive at UL, which is unexpected loss, or you can also say this as ECL. This is expected. What is ECL? Expected credit loss. So what banks does is they will they will check what is the expected credit loss if in case they give you a loan, and if let's say the expected credit loss is less, they will issue you a loan. Okay. If see okay one more thing is one more thing is based how will bank know whether they have to give you the loan or not? This is based on the probability. Okay, if the probability of default is low, bank will issue the loan. If probability of default is higher, bank can choose to reject the loan. Okay, bank might reject the loan. Okay, is the fundamentals clear? Please tell. Is the fundamentals clear? All right. Now let's look at. So this was just credit risk, and what are the components of credit risk modeling? Now let's understand how does the data set look like for a credit risk modeling. How does the data set of a credit risk modeling looks like? So let me check if in case I can get a copy of how the data set looks like. Okay. Please let me know if you can check, look at this I'll just, okay, so let's say, okay. Can you see how does the data set look like? Can you read these? Please tell me, can you read this? Okay. First thing, whenever you look at any credit risk data set, and also this is a very important interview question also, how does your data set looks like? What are the variables in your data set? Okay. So the very first, so of course, okay, just give me one second. Sorry. Yeah. Okay. So this is how your data set, these are the variables that any credit risk modeling data set will have. The first thing is default. Whether, so in the data set, you will have whether the borrower has defaulted or not. So this will be given, which means if you see it, it says that one, if the borrower has defaulted, else zero. It basically means that there will be a column which says default flag, and the default will be 1 if in case the borrower has defaulted, and it will be 0 if the borrower has not defaulted. Then borrower ID is nothing but it's a unique ID. Okay, it's a unique ID so that every borrower, see, every borrower will have a unique ID. It's something like how, when we were back in universities, we had different school IDs or student IDs. It's the very similar thing. FICO score. What is a FICO score? FICO score is nothing but your credit score. You know, it's basically if in case you have taken any loan in the past, or if you are doing any shopping from your credit card, are you able to refund the money back to the company? So FICO score is nothing but it tells you what's your score, what was your historical performance. FICO score is an excellent metrics which tells you what was your historical performance on any credit, be it if in case you have used a credit card for shopping, and if in case you have just paid all the money, that will improve your credit score. If you have used, let's say if you have taken an education loan and you have repaid all the amounts at a proper time, then your credit score will be improved. Income, definitely one of the most important metrics. Why? Because of course, everyone looks at income and then they'll give you the loan. Now this income can be based on it can be either your income or your co-borrower's income, right? A lot of times, you cannot get a loan. So a lot of times what happen is, uh, the banks look at the co-borrower's loan, okay, the co-borrower's income. Employment status, whether you are employed somewhere, let's say, are you working somewhere or you have a business of yourself? Because what happens a lot of time, let's say if you have a business of yourself. Okay, let's say if you have a business of yourself, what will happen is, they will check if in case you have a loan on business or not. Because a lot of times, let's say if you have a steel industry, right? So in the steel industry you have to take a loan for running your business, or in any other industry you have a business and you have taken a loan, then they will make sure they account for those information. Age is nothing but age of the borrower. So it is more likely that, let's say if you are older enough, let's say if you are 40, your chances of repaying the loan is much higher as compared to if in case you are just 20 or you are just 18. Residency status, whether you are renting an apartment or you are owner of your home. This is also very important because a lot of times what happens is they'll ask you for collateral, right? So if in case you are renting an apartment, you do not have any collateral. But if in case, let's say you are owning an apartment, you can provide that collateral. Marital status, are you married or are you single? Because why these are important is marital status means you have a wife. Let's say if you are married, you have a wife. So a lot of times, if you have a wife, definitely, and if she's working, I mean, she can also help you in repaying the loan. That's why all this important. If you see, these are small aspects, but this basically helps bank take a decision whether to give you a loan or not. Education level, what is your education level? Okay, then these were all the borrower's characteristics. Now loan characters, what is borrower? Basically, let's say if I'm going to borrow a loan, these all are my characteristics. Okay, now what is loan characteristics? Which is, let's say if I, first is of course loan ID. Basically, every bank assigns a ID. Okay. Okay, just give me 1 second, guys. Just give me 1 second. Yeah, I'm sorry. Okay, so of course, loan ID is nothing but it is a unique loan identification number. Now, loan amount. How much is your loan amount? How much, value of loan have you taken? Let's say if you are borrowing, if you are taking loan for your education, it can be lower. Let's say $20,000 or $30,000. But if in case you are taking a mortgage loan, it will be much higher. Loan term. So loan term is nothing but it tells you what's the loan duration. How much time you have to repay the loan. Generally, if you see, if you take any education loan, that is for 10 years. If you are taking loan for your home or mortgage loan, it is generally 15 to 30 years. And all this, its loan duration is always considered in months. Okay. Now, interest rates. Interest rate is nothing but what is the interest rate the bank is charging. Okay. And see, for interest rate also, they have certain models in place, like how much interest rate they should charge, which also, it accounts for all the credit risk. If they feel that the credit risk of you is higher, then they'll charge a higher interest rate. But if they feel that, you are a good borrower and, you have a lower credit risk, then definitely they'll not charge that high. Loan purpose is nothing but what's the reason of your loan? Okay. Then origination date is nothing but date. It is the date when the loan is issued. Maturity date is basically, when does your loan matures. Loan to value ratio. Loan to value ratio is a very important. These two are very important metrics for your credit risk modeling. Okay. So sorry, not maturity date. My bad. So it is loan to value ratio and debt to income. So what does loan to value ratio mean? So loan is how much loan have you taken? Value means what is the mortgage value? Just think that if let's say you have taken $100,000 loan of $100,000 value, but if in case your value has increased, is it good for you or bad? Please tell. If let's say now your mortgage value from $100,000 it has increased to $120,000, is it good for you or not? Definitely it is good. But let's see the opposite. Let's say your loan is $100,000 and the value of your home is 70, it has decreased to $70,000. Is this good or bad? This is worst. This is really bad. And this is what happened in 2007-8 financial crisis. And that's why you saw a lot of people defaulting on their loan. It is something like this, let's say there is a house which is of $70,000 and for the same house I'm paying $100,000. Does that make sense? It does not make sense. And that's why a lot of people started defaulting because they thought instead of paying full $100,000 for a $70,000 loan, it makes no sense. So it's better to default. So that's why loan to value is very important. Similarly, debt to income. This ratio is also very important. What is debt? Debt is nothing but let's say if you have taken taken $100,000 loan, and let's say your income is $300,000. So what is your DTI? It's 1/3, which is 33%, which is good. But if let's say your debt is higher and your income is low, then it's actually bad, right? So all this is very important in the credit risk space. Then there are certain performance variables, which is current, which is if in case your loan is current 30 DPD. 60 DPD. Are you aware about what is DPD? Please tell me. Are you aware about what is DPD? Okay. So what is 30 DPD? DPD means days past due. Okay. So so 30 DPD. It means 30 days past due. What it means actually is that your payment is overdue by 30 days. Your payment is overdue by 30 days. So what generally happens is you have this, okay? Let's say let's say there have been terms used, okay? So 0 DPD, 30 DPD, 60 DPD, 90 plus DPD. So at this point, which is if in case your loan is, if your payment is overdue by 90 plus days, if your payment is overdue by 90 plus days, this is when the bank says the borrower has defaulted. This is when the bank says the borrower has defaulted. Okay. This is when the bank says so, and this is also a very formal definition. This is also a very formal definition of default. Even in the interviews, you can be asked, what was your default? What was your definition of default? You have to say that in when I was modeling credit, when I was doing the credit risk modeling project, we considered 90 plus DPD, or you can say we considered 90 days to be our default, which means if someone has is not paying the loan from last 90 days or 90 plus days, that's where you can say that the borrower has default. Is this clear? Please tell, is this clear? Okay, thank you. So now the next is, so we just covered what payment status. Months on book, this basically tells you number of months since origination. Let's say you took a loan 2 years back, so number of months will be 24 months. Why this is important? Because it's very important to understand whether in these last 24 months have you defaulted or not. Have you defaulted or not? Missed payments, this is also important, whether have you missed any payment or not. Okay. Then outstanding balance. This is nothing but how much loan balance is outstanding. Let's say you have taken $100,000 loan and you have paid $30,000 loan. So how much is outstanding? This is $70,000 loan. Okay. Days past due is nothing but days loan. How many days loan is overdue? GDP. So now a lot of times we do use macroeconomic variables. GDP growth is one. Unemployment rate, inflation rate, housing price index, interest rate curves, and these are some derived features from the data set. So we'll talk about this. Don't worry. But if on a higher level, this is what the data set will look like for any credit risk modeling. You'll have certain borrowers characteristics, you'll have loan characteristics, you'll have performance variables on the loan, you'll have macroeconomic indicators. Is this clear? Is this clear? Okay. Now, let's, okay. So what I'll do is, okay, so this was all about the data set. Let me stop this recording. Let me start a new one in which I'll teach you how to perform data cleaning, then feature engineering, and then feature selection and a lot of other things. Okay. Now let me, in the next video, I'll tell you the basically what is the setup looks like for a credit risk modeling. What do you have to do in data cleaning? What do you have to do in feature engineering, feature selection, and so on. So let me first stop this and start a new recording.